Today, we are talking about something millions of people own, but very few people actually understand. It's target date funds. If you have ever had a 401k, there's a really high probability that you are in a target date fund right now. And by the end of this episode, you are going to understand exactly what they are, how you got there, and why I don't like them. So welcome to my show. I'm Danielle Meister, a wealth advisor with Madrona Financial and CPAs, and the host of the Growing Her Wealth podcast. I take you full spectrum from the psychology of wealth to investments, tax planning, real estate, private equity, estate planning, and beyond. Okay, let's begin with a brief history of target date funds and their general intent, because target date funds were introduced like way back in the 90s and became really widely adopted during the Pension Protection Act of 2006. So what that law did is it allowed employers to automatically enroll their employees into retirement plans and default them into default investments, which are often target date funds. The intent was simple: help people who don't want to manage their own investments, provide a set it and forget it solution, and then automatically adjust for risk over time. You pick your retirement year, say 2045, and then you typically see these investments, these firms like Charles Schwab, Vanguard, create the target date fund. So next, let's dive into how target date funds actually were available to you and how you ended up in them. Because there's really just two different ways that you could have possibly become enrolled or added yourself. So the first way is this automatic enrollment. Most 401k plans today, they just default you into a target date fund without you choosing it. And number two, you choose it yourself because it feels really easy. I pick a retirement date and then I'm just done. So to be fair, that simplicity is exactly why they've become so popular. And I want to go back to the first one where you're automatically enrolled. This recently happened to me, and actually it's what prompted me to do this podcast. Last month, my company decided to move our 401k plan over to Fidelity, and my allocations were all reset. And guess to where? A target date fund. And I thought, there must be hundreds of thousands of people that this is happening to, and they don't even know about it, and they don't even know to go in and make a change. Or if they do know to go in and make a change, they don't know what to change it to. So I want to ask, have you ever wondered what exactly is inside of my target date fund? I call them boilerplate funds for a reason. They're generic, they're a one-size-fits-all template, they're used for everyone, and it's just a standard portfolio that is applied to millions of people, regardless of their unique situation. Target date funds, essentially, they call it a glide path type of a fund. And all that glide path means is that when you're younger, you have an allocation that is more to stocks for like growth. And as you get older, you have an allocation that tilts more into bonds for what they say stability. Let me give you some quick examples here, because if you're in, say, a 2030 fund, well, that means you're close to retirement. Maybe 40 to 50% of the allocation is in stocks or equities. And that maybe the other 45 to 60% is in bonds. And let's do another example. Let's say you're in a 2045 fund. You're midway through your career, and perhaps 70 to 80% is in stocks or equities. And the other 20 to 30% is in bonds. The last one, somebody who's really far away from retirement, they're early in their career, might be in a 2060 fund, which you would assume might be 90% stocks and 10% bonds. So the shift with a glide path, it's automatic, and the allocation that you get is all the same for every single person that is assumed to be retiring in the same year, regardless of your income, your tolerance to risk, your outside assets, your tax situation, and believe it or not, yes, the firm that created the target date fund and automatically enrolls you in it, they also profit from you being in it. It's like this whole self-fulfilling system that they've created. And I'm not a really big fan of this, as you can see. I think that funds and allocations need to be set specific to the person, not boilerplate. Everybody gets the exact same investment allocation, regardless of who you are and what your situation is. Now for my favorite part, the bond problem. what bonds are supposed to do versus what they actually do. Okay, let's do historically. Historically, bonds serve two roles. They, one, provide income, and two, they're supposed to stabilize a portfolio when stocks fall. Now, the question is, does it actually do that? Here's the real issue, and it's the performance reality. The US bond aggregate, US bond overall index, likely a portion of the portfolio if you're in a target date fund. It has delivered on average, let's do 5, 10, 15 years, next to nothing. 5-year US bond aggregate, on average, flat, annualized, 0% rate of return. 10-year annualized bond aggregate, 2%. And the 15-year bond aggregate is at 2.5%. This is dead money. And why have bonds struggled? It's no surprise. Ultra low interest rates for a decade, aggressive policy shifts by the Federal Reserve, so money supply artificially manipulating interest rates, rising rates, so it's a teeter-totter, rising rates creates bonds will fall in value. And so instead of stabilizing and generating meaningful income like they were supposed to do, they've acted like dead weight inside of your portfolio. So how is this helping people who are getting closer to retirement or people who are already retired? Here's what doesn't sit right with me, is that these funds, again, assume that millions of people have the same financial life. They reduce your risk by shifting you into bonds that have not performed. And then they do this automatically without any context. And the big question for me is, are these firms acting like your fiduciary? Are they acting in your best interest? Because I would think that a large firm like Fidelity or Vanguard, Schwab, I would say, well, how do you know that every single person that is being put in the same target date fund should actually be in an allocation like that? I just don't know how it can be such a broad brush stroke. So again, it's standardized, and of course, it's really convenient. It's really easy. But do you want to be in a product that is convenient and easy, or do you want to be in a product that's actually designed to be right for you? Because they're really two pretty different things. So, what do I prefer instead of target date funds? And instead of, really, for me, it's what do I prefer instead of bonds? Because the goal is for a lot of people to get more conservative, but we need to still grow. There are other asset classes that can act like bond replacements and account diversifiers. I want to be looking not only at just stocks and bonds and a stock bond split, but also bringing into the conversation things like private real estate, private credit, structured notes, buffered ETFs, preferred stock, MYGAs, multi-year guaranteed annuities, so fixed rate of return, fixed rate over time, no market risk, accumulation annuities. Maybe it makes sense to introduce other asset classes that will act like a bond would have, or what it was supposed to do, add stability, income, and diversification, but with better return potential. And unlike the bond aggregate that has returned next to nothing for 5, 10, or 15 years. So all of these bond substitutes are options that I would prefer to use inside of a portfolio. So there are a few challenges here. What are they? Two big ones. One is that most of these bond substitutes are not available inside of an employer plan like a 401k. And number two, they're not accessible to do-it-yourself investors. You actually have to be licensed to have access to them. Let me give you a story. A woman that I worked with, she has worked at Boeing when she came to me for 32 years. She started her 401k at age 19, and she thought, I don't know what I'm doing. I'm just going to pick something really easy. So she chose, of course, a target date fund. She selected her estimated retirement date. And then, of course, she was a Boeing employee. So she invested in some company stock as well. She maxed it out every year, did everything right. She didn't look at it. She didn't question it, but she just was busy. She was raising kids, climbing the corporate ladder, traveling internationally for the company. It was out of sight, out of mind, until retirement started getting close. And this is when we connected. And suddenly fear, confusion, hesitation What do I do with this? I've really never done anything investment choice related before because nobody ever helped her understand what she actually owned. So, what do we do about it? Well, one, I wanted to get the target date fund out of her portfolio. And there's a couple of paths to getting out of a target date fund and then selecting investments that actually make sense specifically for you and for the life that you want to live and create and the portfolio that aligns with it. So take notes here. You will most likely fall into one of the following categories. If you are a do it yourself investor, you can navigate a lot of these steps on your own. It's going to take a little bit of homework, but you're used to that. You're a do it yourselfer. And I would just say the only thing you may be limited without proper licensing to some of the bond substitutes that I've listed. But follow along because there are ways that you can do this yourself. And then on the flip side, if doing this yourself completely terrifies you or you feel stuck, analysis paralysis, you don't know the right funds to select, you don't want to get it wrong, here's a few options where you can seek help along the way. One, begin by asking the question, or we begin by asking, are you still employed by the company who runs your retirement account? If the answer is no, you've retired or moved on to a new company, you have the option to do what's called a rollover. And you're taking your account balance from a 401k. It could also be a 403b. You can do this with a number of employer accounts, and you're rolling it over to an IRA. IRA stands for Individual Retirement Account. It's a tax deferred, non taxable event. So when you transfer the account over, there is no tax consequence. You're able to sell the funds, no problem. And when you get into the IRA, you have access to thousands more investment options. You can build your own investment allocation, or you work with a trusted advisor to help build an allocation that's unique to you. But honestly, guys, be careful. You don't want to hire somebody who sticks you into a 60-40 stock bond split. There's a lot of advisors out there. It's basically the same thing as putting you back into a target date fund. And you also don't want to hire an annuity salesperson. You need someone who can invest in everything. You want to have access to these bond substitutes that we covered earlier. Now, going back to that question, if you answered yes, and you are still with the company that administers your 401k, you have three options. The first one I want to see, are you in a category where you are 59 and a half or older? If you are, many companies will allow you to do what's called an in-service rollover or an in-service distribution, where you roll the funds out of the active 401k and into your own IRA, and then you can invest it however you want. You aren't limited to the small little menu of options that your 401k plan put in place. And yep, you can keep your 401k open and keep contributing to it, keep getting the company match. But with your IRA, you can either manage it yourself as a do-it-yourselfer or work with a trusted advisor to choose a complete allocation that is, you've got access to all of the investment options out there and put an allocation together that makes sense for you. So number two, if you are still with your current company and in the 401k or the retirement plan, ask yourself, am I one of the 40 million people who hold a retirement account at Fidelity? Many employer plans and 401ks are at Fidelity, and they've got this secret little button that can connect you to the outside investment world. So write this down. It's called Brokerage Link. And an advisor like myself can come in and actively manage your 401k once it's brought over to Brokerage Link. No more target date funds, no more cute little menu of investment options. And you can do this at any age. Again, do-it-yourself investors, go to Brokerage Link and you can have access to the complete universe of investments that are accessible through Fidelity. It's a little tricky again to access through Brokerage Link, getting into some of the alternative investment spaces, but it absolutely gives you more access than just the little menu that the 401k offers. Number three, if you are still with your current employer and you are not 59 and a half, and you cannot do an in-service distribution, and your 401k is not with Fidelity, you did fall into the first two categories. You're still employed with the company that administers the retirement account. There are still ways to get out of your target date fund and into something more unique for you. Number one, if you are a do-it-yourself investor, log into your 401k. Sell the target date fund. There is no tax impact to sell inside of your account. It's all tax deferred, and go build your own allocation. But you have to remember, update both the existing balance as well as your future contributions. Both need to be updated. If you don't want to do it yourself and you want help, there are trusted advisors out there that help you get out of the target date funds. You can select investment options that are unique to your needs, but your advisor has to have the right technology to actively help you do this and to have oversight and continue to do things like make shifts if your portfolio falls out of alignment and to keep you in tolerance. So, in closing, if you take one thing away from today, let it be this. Just because something is easy doesn't mean that it's the right thing for you. Your retirement is too important to outsource to a one-size-fits-all boilerplate solution. If you are sitting in a target date fund and wondering whether it actually aligns with your goals, that's exactly the kind of question that we help people answer every day. To get in touch with me or my team, visit my website, growingherwealth.com, and click Request Analysis. Or you can also call my team at 833-673-7373 and book a 15-minute introductory call with me. Thanks so much for listening. I'm Danielle Meister, and I'll see you next time.